Welcome to the CNBC-TV18 special. I'm Shereen Bhan. We're coming to you live from Davos 2024. You've seen a slew of headliners here on CNBC-TV18, and joining me now is the RBI Governor, Shaktikanta Das. Mr. Das, always a pleasure. Thank you so much for joining us here on CNBC-TV18. You're quite the envy here of everyone in Davos. Mr. Das, I was looking at a press conference that you were doing a few days ago as you arrived in Davos, and many were sort of almost, saying that they were feeling jealous of the position that you find yourself in.
It's now good morning, and thank you for having me here. Now, I can't say how others are looking at India, but I think the journey has been quite challenging, almost for every country, especially in the last 4 years, which I have described elsewhere as the period of great volatility. And the volatility and the challenges on the global scale are still continuing. So amidst all these challenges, I think India has navigated very well. The various authorities, agencies, and in the case of the Reserve Bank, I think overall India has navigated well. In terms of macroeconomic stability, macroeconomic growth, in terms of financial stability, in terms of monetary policy actions and their outcome and bringing inflation under control, I think India is today well placed. It showed its resilience, and India is well placed and also well placed to deal with many emerging challenges. But having reached this point, I think what is now the focus, which should now be the focus, and what is our continuing focus, is to maintain that stability, maintain that resilience, and work towards improving it and strengthening it further. India is on the whole doing well, and will continue to do well as per the current indications.
Let me pick up on that comment that you made, and you have called it a period of great volatility between 2020 and 2023. On the back of the conversations that you've had here in Davos, as well as some of the emerging uncertainties, for instance, the attacks that we are seeing on the Red Sea, etc., what is the outlook now as far as 2024 is concerned? Domestic, of course, as you rightly pointed out, much more stable, relatively calmer. But what about the global factors that we will need to be watchful of?
You see, all these global geopolitical flashpoints are evolving. Around the Red Sea region, how it will evolve in the coming days, we have to wait and see. Only the time will tell. As things stand today, India will be able to deal with the existing challenges, but we have to see how it all plays out in the future weeks or months. And this kind of uncertainty, I think, is what is making policy making really that much more complex.
Speaking of complex policy challenges, the central banker's dilemma and the central banker's challenge at this point in time is that there is a clamor from industry, from consumers, perhaps even from government, to cut rates. But there is a fear and the risk that if you move too prematurely or too early, you could in fact cause more disruption and upset things further. I know you've firmly said that there will be a change in stance or a cut only if we get to 4% on a sustainable basis. But as a central banker, and you've been talking to other central bankers here as well, isn't that the big challenge and the big dilemma for you?
I think, you have partly answered the question. You see, the markets all over the world, the markets are running ahead of the thinking of the central banks. In India, you mentioned that there is an expectation from various quarters about a rate cut and all that. Frankly speaking, the serious players in everywhere, whether it is the industry or the private sector, or it is the analysts or the economists or the serious the market players, in the context of India, I don't think anybody is expecting a rate cut now. In most of the advanced economies, the markets and the stakeholders and the market players, their assumptions, it is ahead, they're overrunning their central banks. So far as India is concerned, I think the thinking of the central bank and the thinking of the market participants, they are much better aligned. In inflation, with regard to inflation, I have said elsewhere that our policy has to remain actively disinflationary till we reach the target of 4% on a durable or a sustainable basis, and that is our current stance. You see, ultimately, why are we working towards this 4% inflation? Because a stable inflation, a stable what we call price stability, provides the support, the required support. It acts as a bedrock for growth, for sustainable growth. Otherwise, you will have off and on data of growth doing well, then again slipping back. And a premature, you are right, absolutely right in saying that any premature pivot in our policy, it can be very, very costly for the economy.
You know, you talked about growth, sir, and the NSO advanced estimate has pegged growth higher than the RBI's estimate. On the back of the data that we are looking at today, do you believe that there is an upside projection or growth could do better than your own estimates?
You see, we said 7% for the current year. Our earlier projection for current year, that is 23-24, was 6.5%. In October, in end October, when I said, in one of the events and followed up by our monetary policy statement, when we said 7%, our previous number was 6.5%, and I think the market was also around 6.5%. That time, 7% was seen as optimistic. But subsequently, the NSO, that data which came about a month later, so naturally they had a later period data. And NSO has access to several data to which we don't have access. Now 7.3, and in fact in the monetary policy conference, we had said, in fact the deputy governor had said that, it's actually 7% is a conservative estimate. So we were expecting that it can exceed 7%, but we wanted to be absolutely, absolutely sure about our number. Even for next year, I have said yesterday that the growth momentum is a momentum of economic activity is well maintained, and next year growth will be touching 7%. And when that happens, for 4 consecutive years, successive 4 years, India would have recorded a growth of 7% or more.
So confident as far as growth is concerned?
We are confident. Unless, we are confident, unless I am confident, I will not say. I will not speak about it.
I'm sure about that. But let's talk about what's happening as far as the markets are concerned. And yesterday, we saw a significant impact on the banking sector, on the banking stocks in specific. HDFC Bank came out with its numbers. There is a concern now as far as deposit as well as credit growth is concerned, and deposit growth not keeping pace with credit growth. Are you concerned about that?
You see, our deposit growth, if you see the last 1 or 2 years, the deposit growth has been around 12 to 13%. The credit growth has been about 15%. Now, obviously, you see, it's not that you get X amount of deposit and you extend that X amount as a loan. It's not like that. Each loan that you extend, money creates money. The money multiplier happens in the market. So obviously, the credit will be little, will always be little higher. Now the question is whether it is unduly higher or it is sort of has a correlation with your deposit base. At the systemic level, at the individual entity level, at the moment, we don't see any risks. We are doing our regular, our supervision has become much more intense. We have now an ongoing method of our supervision is ongoing. It's not once in a year annual inspection or annual supervision of the banks. So at the moment, the Indian banking sector at the systemic level is very robust. Even at individual entity level, it is very robust with regard to stock prices, the stock market prices. You see, stock markets have their own dynamics, and stock market, the prices, share prices in the stock market do not necessarily reflect the fundamentals of a company. I'm talking in general terms, not with reference to a particular bank. Generally, if you see, the stock prices are determined by so many other factors and do not necessarily reflect the fundamentals of a company. You have examples in every sector, whether it is the financial services or banking or any other sector you look at. There are companies with very strong fundamentals, but its share prices should be low. And the converse also happens. So therefore, it will not be correct to, judge the health of a particular sector like banking in particular in terms of share prices, movement of share prices, and that too on a single day.
There is a concern or perhaps confusion as far as the credit deposit ratio is concerned and whether the RBI is likely to mandate a number or not. Could you clarify this for us?
You see, we have not mandated any number. I think there was, let's leave that. But what I would like to say very clearly is that we have not mandated any number. that this shall be the credit deposit ratio. We have not, and at the moment we don't propose to, because credit deposit ratio is just one of the parameters to assess the health of a bank. There are several other parameters. So you have to look at it all in totality. All that I can say is that there should not be exuberance in lending, number one. Number two, there should be some correlation between your deposit base and your credit growth. There should be some correlation. But in terms of hard coding it, in terms of a particular number, there is no such proposal in our mind, and we have not prescribed any such number.
Is there signs or evidence of exuberance that you just spoke of, or misalignment in any particular cases, individual cases at this point in time?
You see, not at the systemic level, not with regard to overall credit. We saw some signs of it in, with regard to the personal loans, especially the unsecured loans. We saw also some amount of, with regard to the interconnectedness between the banks and the NBFCs. So at the sector, not even at sectoral, in subsectoral level, wherever we, in places where we saw a possible buildup of exuberance or a possible buildup of stress, we have already acted. In November, we have issued the required, we have increased the risk weights and we have acted. But the numbers as they prevail today are actually not bad. The numbers are okay. But we have acted preemptively. We felt that if we allow this to continue and if left unattended, this can create a potential situation of stress. So we were dealing with a buildup of stress, a possible stress from actually materializing. So it was a kind of a preemptive action to prevent the kind of fear of missing out, or a kind of what could have become a possible exuberance.
Yes, you said that you didn't want to wait for the house to catch fire, and hence you acted preemptively. Any other areas where you feel that you may be forced to take preemptive action? Usurious rates, for instance, for MFIs, is that at all a concern for you at this point in time?
You see, we are monitoring almost every aspect of the banking and the credit space of the entire credit ecosystem. As and when something becomes necessary, we will definitely act, and our actions will always be, our endeavor is always to make, to take preemptive and proactive actions.
On the back of the measures that you've already taken, and one involving the AIF, so there are representations being made by that industry, by the AIFs, etc., to the Finance Ministry as well as to the Reserve Bank, saying that perhaps there needs to be a review of that decision, or at least more time given. You've obviously, I would imagine, have heard from them. How do you respond to that?
You see, this decision is the result, is the culmination of more than 1 year of keeping track of the developments in the AIF sector. It's not as if suddenly something came to our notice and we acted. We have been tracking these developments for about more than a year now. And initially we saw some signs here and there. So when we see some signs here and there, we try to deal with it on entity-based approach. Our supervisors take it up with that particular entity and try to deal with it on a bilateral basis. But when we see something, becoming, showing signs of getting widespread, we had to act.
How widespread is the problem today?
No, I can't again quantify it, but there was this whole issue of evergreening that was taking place. So therefore, that had to be prevented. All that we have done is that we have also said we have not stopped any lending. We have only said that if you want to continue, you treat it as you treat it in a particular way, and you provide for it in your accounts. And so that is what we have said. And some representations have come. They are being examined.
But could there be any kind of review as far as the decision is concerned?
No, I can't say. It is being examined. We have got number of representations. They are being examined. And with regard to the decision, it's a well thought out decision to prevent a kind of a new source of stress or a new source of problem for the Indian banking sector. Please remember where the what was the health of the Indian banking sector 10 years ago and where it is today. In fact, the gross non-performing asset has reached an all-time low of 3.2%. The profitability of banks are very good. The capital adequacy of banks are about 16.8%. And our stress tests also show that even under severe stress scenarios, the banks will be able to maintain their minimum regulatory capital. So we have to be therefore very careful. The banks have to be careful. The banks are careful. I see a clear improvement. I see a clear improvement in the risk management practices and in the governance practices of the banks. But more needs to be done, and we are working on that.
Would you extend the same view as far as NBFCs are concerned?
NBFC sector is definitely far better, and the numbers also are, numbers in the NBFC sector are also very positive. They are also, I would say, quite robust. And particularly the bigger ones, after the scale-based regulation, as you know,
yes.
We have we have different regulations for depending on the size and complexity of the NBFCs. So NBFC sector parameters are also looking good, and again, they have recovered in the last 4 years in the post ILFS scenario. They have recovered very well. In 2019, when I joined Reserve Bank after about 2-3 months after the ILFS crisis, end of 2018 and the whole of 2019, the entire, there was a crisis of confidence. There was a lack of trust on the functioning of NBFCs. And I am happy to mention here today that both as a regulator, we work very constructively with the various financial sector entities and with the sector as a whole. So as a result of the efforts of the Reserve Bank and the efforts of the individual, particularly the large and the medium size NBFCs, that sector is today much healthier than it was earlier.
Let's talk about another emerging sector, and so that is the Fintech sector, which has, of course, seen a accelerated growth trajectory over the last few years. What's your take there as far as regulation is concerned, SROs, and especially given the kind of explosive growth that we've seen?
You see, there are 3 things I would like to mention. One is that there are NBFCs and also there are banks which do lending through digital means. So there are NBFCs which are primarily focused on digital lending. Now that was a growing sector, and that needed to be properly regulated, and the regulatory architecture had to be defined. So therefore we appointed a committee. The committee gave its recommendations. That was, the discussion paper was put out. We got the comments. We had wide-ranging consultations, and we have issued detailed guidelines for the digital lenders in the digital lending space. In fact, when we did that, there was some amount of criticism that RBI was trying to stifle activity in this sector. But let me tell you that the fact that it is now regulated by the, by the Reserve Bank, and there are clear regulatory guidelines, it has increased the trust of the investors, and it has become, so there is greater investor confidence on digital lending. That is the first thing we have done. With regard to fintech companies, which act, they are not lenders themselves, but they provide technology solutions to lenders, and they come out with products, and they act as third-party service providers to regulated entities of Reserve Bank, like the banks and NBFCs. There also we have issued instructions to NBFCs and to the banks with regard to the code of conduct and with regard to the practices that should be followed by their third-party service providers. And the bank, that is the regulated entity of the Reserve Bank, whether it's a bank or a NBFC, so far as we are concerned, he will be accountable. And to that extent, he has to regulate the fintech companies. But the way, and the fintech companies are growing exponentially, they should grow. After all, modern times belongs to technology. RBI, we are clearly focusing on supporting technology, encouraging technology. At the same time, we want to sort of have well-defined parameters where it evolves in the right direction without creating any potential stress, and keeping in mind the interest of the consumers, the interest of the, the customers in terms of interest rates, in terms of safety of their money. So therefore, we have thought about this SRO, the self-regulatory organization, which will be an intermediary body between, and there could be more than one SROs, Whether we should have a single one or multiple ones. If multiple, then how many should be, is a part of a discussion paper which we have just uploaded, released last week with regard to, I think earlier this week, with regard to the, or was it last Friday, whatever, very recently on the SRO in the fintech sector.
Correct.
Our idea is that this self-regulatory body will have the fintech companies themselves as its members, and they will act as an interface between the Reserve Bank and the fintech companies, and certain amount of code of conduct, business ethics, and certain business practices, certain minor details can be left to the SRO to deal with under the overarching principle-based regulation which we will prescribe. Then the SRO also will be closer to the fintech players. He will be in a position to have a better sense of how technology is evolving, and he will be able to keep us also apprised that this is the direction in which things are happening. So therefore, on the whole, to sum up a long answer, our effort is mainly to see that the fintech ecosystem grows and grows in a robust manner in India, but it should grow in a proper regulated environment so that the interest of customers are well protected, and it's a kind of a sustainable growth which is achieved, not that we one-off kind of growth which happens and then suddenly it crashes. The growth of that sector has to be sustainable.
Well, you talked about modern times and technology, and the Reserve Bank and you particularly have emphatically said no as far as cryptocurrency is concerned. Globally, we've just seen an ETF being given the go-ahead, but no change in position as far as cryptos are concerned?
You see, let us differentiate clearly. There's a clear difference between the underlying technology of the so-called cryptocurrencies and the cryptocurrency as a product which is basically a speculative product. The underlying technology has been there. The underlying technology will be there. We are using blockchain. For example, blockchain, we are using it in our CBDC trial project. Blockchain has many applications. It will grow. It needs to grow. We are using it. There are many users who are also using it. Tokenization also needs to grow. Tokenization will facilitate what you call a large value asset. It an ordinary individual who doesn't who doesn't have the affordability can become a part owner of a high valued asset. That is what blockchain will facilitate. That is what tokenization will facilitate. That is the technology part of it. The technology part of it needs to grow, but the product which is bought and sold in the market, which is traded, it is a highly speculative activity. It has got several, downsides to, several downsides which can pose risks to financial stability. So we need to clearly differentiate. Technology has to grow. That's what I said. We have problems with regard to the product of what is called cryptocurrency, which is, which is sort of being marketed. It is a speculative product, and it is being sort of marketed as an asset. Let's leave it at that.
Yeah, one of the other issues that I want to take up with you is your comment saying that institutions like the IMF, etc., need to take a much more balanced, nuanced view of emerging markets like India. And you said this in the context of currency management and the IMF's change as far as classification is concerned. What is it that you believe they're failing to perhaps recognize or understand, the nuancing that they're failing to recognize or understand?
I think it should be recognized that an emerging market, it's not an India problem. It's an emerging market issue. They should keep in mind the fact that emerging markets have to ultimately protect their own economies. You have volatility in the international markets, in the financial market. You have volatility in the most powerful currency. The dollar index at one stage went up to about 114. Then it came down to about 101. Now it's holding around 103. And all this has happened in the last 2 years. So see the volatility there. Now, if that volatility translates and causes equal amount of volatility in the emerging market currencies, where will they go? What is the safety net that emerging market economies have? So emerging market economies have to sort of build up their own strength and build up their own buffers. In Reserve Bank, as a part of our active, we have, as a part of our explicit policy, we have embarked on strengthening and building up higher reserves. Our reserves are around $620 billion, at the moment. So individual emerging market economies have to insulate and protect their economies from the spillovers of the the global currency movements and the fluctuations. They have to ensure stability of their currencies. And by stability, what I mean is that undue volatility has to be, prevented. The Reserve Bank's intervention in the currency market is only to prevent excessive volatility. This has been the stated policy of RBI for so many years, and I would like to reiterate that that continues to be the policy of RBI. The stability of the Indian rupee, if you are trying to measure the stability, the question is what time period you look at. You pick up 11 months and say that during this period the rupee has remained stable. Yes, it has remained stable. But why the rupee has remained stable? Please look into, please do a deep dive and do the analysis. Rupee has remained stable because of India's strong macroeconomic fundamentals, because of stability of the Indian financial sector, because of return of forex, foreign capital inflows. The FPI inflows have increased. It's about 32.5 billion this year on net basis. FDI is about $10 billion, and India is one of the larger recipients. So Indian currency and our external sector is also very robust. With a forex buffer, the investors have greater confidence on India's ability to service its external obligations. With all these confluence of factors, naturally the rupee has remained stable. You have to recognize as the ground reality. You cannot just pick up 11 months and say that rupee has remained stable. You look at the 2-year horizon. After the Ukraine war in 2022, the rupee depreciated by about 10%. Now, so if you look at a 2-year horizon, the rupee depreciation is about 4 to 5%. And historically, if you see, even over last 5 years or 10 years, historically, if you see, the annual average depreciation of the rupee has been about 4.5%. Even now, the annual depreciation is 4.5%. So I think, we have said it in the in our reply, which is already published as a part of the RBI, our response to the IMF report. So what we are doing is that we would like to say and impress upon the the IMF, or for that matter any agency, to look at these ground realities and realize and appreciate the challenges which emerging market economies on the whole they face, and their priority is to protect their domestic economies. You cannot take away that right from these countries.
Speaking of ground realities, let me talk to you about private capex. And you did say that there are signs indicating that we are seeing an uptick as far as private capex is concerned. Where do you see that? And, where are we in that cycle at this point in time?
You see, capacity utilization of the manufacturing sector is about, has reached now 75%. And capacity, the capex is happening in several key sectors. First thing is the government capital expenditure has been quite strong in the last 5 years. That is continuing to drive growth. That is also generating private investment. Private investment is showing, first is the credit growth in India has been very robust. Of course, large part of it is going into, the retail part of the lending. But some amount of lending, if you talk to the banks, the leading banks in India, they are also seeing a lot of, the business interest and a lot of active proposals for lending for capex. But capex is actually happening in certain core sectors like steel, cement, petroleum, and I should say agricultural, products. And a lot of capex is also happening in startups and in the fintech companies. So that cycle has started.
The action that you took as far as unsecured loans are concerned, are there any other pockets where you believe that there are signs of overheating, where you may not have intervened yet, but you may have to intervene?
No, we are, we are very actively supervising our, the entire supervisory method of the Reserve Bank over the last 4-5 years. There has been a paradigm shift. And as and when we see any stress anywhere or any risk anywhere, we will act.
So nothing at this point in time that you believe may lead to some preemptive action?
It's a moving situation. Let us see.
So, let's talk about the last 5 years, sir, as RBI governor. It's been a challenging time. You yourself, in your phrase, said a period of great volatility. What do you believe have been the hardest points to navigate through? What has been the most challenging aspect of maneuvering the RBI of maneuvering the economy, of maneuvering the financial sector through the last 5 years?
You see, every new challenge looks bigger than the previous one. Let me put it that way. In 2019, the scenario which prevailed in the NBFC sector, with crisis of confidence in that sector, activities had come to a standstill. That appeared to be a very big problem. But then you had COVID and its fallout. Then you had the Ukraine war. Then synchronized monetary policy tightening. Now the new flashpoints in global, in geopolitics, in supply chains. So therefore, every challenge looks actually bigger than the previous one, and we have to remain prepared to deal with such challenges. For a central bank, it's never a dull moment. And our endeavor is to sort of live up to the expectations which the country has and, on us, expectations which people have from us. And our effort and endeavor is always to live up to that. And one thing which I think I can say with confidence, what the Reserve Bank has been able to achieve over the last 5 years is to bring about financial sector stability and also contribute to macroeconomic stability of the country.
You talked about never being a dull moment as far as the RBI is concerned. I would imagine that that is the case. But let me ask you about growth priorities. I know that your mandate is inflation, but let's talk about growth priorities in the context of the fact that we now have a vote on account and then, of course, the full budget coming up. So what would you like to see as far as growth priorities are concerned?
No, I think it's not appropriate for me to...
I'm not asking you to comment on the budget. But in general.
I think the growth should be, the growth is at the moment, economic growth, the growth is, the momentum continues. The the economic activities on the overall economic activities are maintaining their momentum. And that's why we have said that 24-25, I have said yesterday that, we expect a growth of 7% in the next financial year. So the growth has to be sustainable. The rate of growth also has to improve. And it is happening. You see, the potential growth of the Indian economy is also steadily rising. Our potential growth was about 6% or so in the year of the COVID. Then some research paper published by the RBI researchers talked about the potential growth of India being 6.5%. But now the growth is, for the last 3 years, including the current year and next year, hopefully. And we do believe that it should be, it will be 7%. If that happens, as I said, 4 years of 7% growth. So actual growth is therefore running ahead of the growth potential. So therefore, we expect India's growth potential also to move, towards 7%.
Let me end by asking you, what is the one thing that you're excited about today? Here people are talking about AI, talking about the impact of that and so on and so forth. But, on a wide canvas, what is the one or two things that you're most excited about from an India perspective?
I will not say I'm excited about, but I can say that I see some very positive signs about, growing confidence on India, growing expectations from India that India will be a country which will perhaps play a bigger role in global growth, expectation that India will provide the necessary momentum to world growth also. The IMF has projected that India's share in global growth will go from the current 16% to about 20%. No, 16% to 18%
right.
By 2028. So therefore, what I see here, I cannot say that I get excited. I'm not excited over everything. One has to maintain that amount of equanimity, more so in a central bank. But I think there is growing interest on India, there is growing confidence on India, there is growing expectation that India will play a bigger role in the global economic growth.
RBI Governor Shaktikanta Das, always a pleasure. Many thanks for joining us here on CNBC-TV18. Appreciate your time, and we look forward to seeing you back in India. Thank you so much for joining us here, sir. That is the RBI Governor speaking to us. We will take a break here and return with a lot more. Stay tuned. We're back in a moment.
Can I just